Hello again and welcome.
In some businesses, you might actually come up against a cost that actually looks like, look at this graph here. And I would call this kind of a cost that appears to be kind of a stair-stepping cost. Well, let's look at this graph carefully. What we have here is a measure of our total supervisory salaries per year. And we're showing supervisory salaries at the level of $40,000, $80,000, $120,000, $160,000. And we show on the horizontal axis increases in volume going from 0 to $10,000, $20,000, $30,000, $40,000. If in fact you look at this stair-step cost, what it appears to me is that if in fact we're doing a volume of business, manufacturing and sales of our goods, that numbers anywhere from 0 to 10,000 units, we need one supervisor for which we pay $40,000 a year. But if in fact we exceed 10,000 units of volume in our business, and anywhere from 10,000 to 20,000 units of volume, we're going to have to add an additional supervisor. One person just can't supervise that level of production. And so we might have to have two supervisors. At an annual salary of $40,000 per supervisor means the total supervisory cost would be $80,000 during that range, in that range of volume. And again, if we exceed 20,000, anywhere between 20 to 30,000, we need another supervisor, three supervisors, and now our supervisory costs are $120,000 and so on. In this particular case, what do we have here? Do we have a variable or a fixed cost? Because in order for me to do cost volume profit analysis in a fundamental way, we need to identify all of our costs in this case, and we need to distinguish it as either perfectly fixed or perfectly variable to simplify the CVP analysis. This clearly isn't perfectly fixed or perfectly variable. So what am I going to do in this particular situation with this cost? I must designate it as either fixed or variable. Well, I guess that kind of depends upon what, again, I anticipate as my relevant range of volume in terms of the production and sales of units. If, in fact, I think that on a monthly basis, we're going to manufacture and sell somewhere between 10 and 20,000 units, such that the relevant range is that range of volume, then I could say that my supervisory salary is legitimately a fixed cost within that range, $80,000 fixed. But what if, in fact, our relevant range during any particular year was somewhere between 10 and 30,000 units of production? Well, in this particular case, I got a problem because it might be at the lower levels of volume, $80,000, at the higher levels of volume, $120,000. So what number am I going to use? And am I going to identify it as fixed or variable? In this particular case, you're going to just have to exercise your own good judgment. This cost volume profit analysis tool that we're going to be utilizing here shortly is not a precise tool. I mean, that's clear because we've stated already that we're never going to necessarily have a perfectly variable cost, and we said that we're going to make an assumption that within the relevant range it will be perfectly variable cost, assuming it's a straight line and therefore the variable cost per unit within the relevant range is constant or fixed. So we've already said that we're going to apply some assumptions in this process. Here we're clearly going to have to make an assumption. We're going to have to assume that this is either a fixed cost or a variable cost. Now let's assume that we are going to assume that it is a fixed cost, although it clearly is not. If in fact we said that this is going to be a fixed cost, I'd have to say at what level is it fixed? Is it fixed at $40,000? And so are we going to really basically imply that we've got a straight line here through these levels of volume and we're only going to need two supervisors? That probably isn't realistic. Maybe we should go up here and say, well, we're going to use $120,000 as a fixed cost during this range of volume from 10 to 30,000 units. But that might not be, certainly isn't appropriate given the fact that our costs would actually be less at a lower level of volume. Maybe what I would do if this were my business and I was trying to do this kind of analysis, I'd probably split the difference and just maybe take it at $100,000 and say on average for this level of volume ranging between 10 and 30,000 units per year, that we think that the average fixed cost would be $100,000. that would be okay. I mean, you're going to have to identify it as either perfectly fixed or perfectly variable, even though clearly is not. So to say that, it's a perfectly fixed cost at $100,000 throughout this range of volume is not accurate, but, maybe it's a close approximation that we can then use in our cost volume profit analysis to do, to come up with something close in terms of the results of that tool. Some other people may look at this particular stair-stepping cost here of supervisory salary and say, hey, within the range of 20 to 30,000 units of anticipated volume, that really looks more to me like a variable cost. What I'd like to do there is, instead of drawing a straight line, making an assumption that it's a fixed cost, to me it looks more like it's a variable cost. And they might draw in here a straight slanted line through this range of volume that kind of intersects, these fixed costs in some way. Clearly this is not a perfectly variable cost, but this would be another approach in terms of trying to distinguish this cost as either fixed or variable, would be to say, well, we're really going to call this a variable cost. In that particular case, I draw a line through here that looked like, just from a visual standpoint, it kind of fits in terms of being kind of an average variable cost. And then I would just simply take 2 points on that line, calculate the slope, and say, I'm going to assume that this is a perfectly variable cost, although it clearly is not, and calculate the slope of this line between 2 points, and say that that is going to be my variable cost per unit. What I'm simply saying here is, in this kind of a cost, you're going to have to assume it's perfectly fixed or perfectly variable, and it's not going to be accurate either way. You're just going to have to kind of force it into the category of fixed or variable, and then come up with the amount on what looks like it's kind of an average. If I were to tell you that, in fact, this particular range of volume during the year is somewhere between 10 and 40,000 units, then you might really say, well, now it really looks to me more like a variable cost. And again, I might draw a slanted line through that kind of is a fair representation of all of these costs. And again, simply refer to it as a variable cost, even though it is not clearly perfectly variable. And I'd simply calculate the slope of that line and include that variable cost per unit in my accumulation of all of the total variable costs as I begin trying to utilize this tool of cost volume profit analysis. Again, we're simply identifying all of our costs, product or period costs, and we've defined now perfectly fixed and perfectly variable costs, because if in fact we can identify all of our costs as perfectly fixed or as perfectly variable, we can implement this tool called cost volume profit analysis. So as I identify all of my costs here, I notice that some of them aren't perfectly fixed and aren't perfectly variable, even within the relevant range. And in that case, I'm going to just kind of force it into the category of fixed or variable and assume it's perfect within that relevant range, even though it clearly is not. There are some costs that actually behave in a way that they're kind of mixed. They actually have a little bit of fixed cost and a little bit of variable cost. And for example, it might be the contract might read something like this, that your monthly rental cost to lease this space is $1,000 a month plus 10% of your total sales revenues. Well, in this particular case, we have in our rental costs, some of it is fixed. We've got $1,000 a month that is fixed regardless of what our volume is. But we also have this additional amount of rental cost that is predicated on 10% of our sales volume in terms of the total amount of sales revenues that we generate through our store. If I were to graphically represent this mixed cost, a little bit of it is fixed and a little bit of it is variable, such that the vertical axis here represents my total rental costs per month, and the horizontal axis in this particular case represents volume, but we're going to measure volume not in terms of the number of units in this particular case, because the contract doesn't have this kicker based upon the number of units, but rather we're going to measure our volume in terms of the amount of our dollar amount of sales revenues. So the volume here is either zero in terms of sales revenues, or $10,000 of sales revenues, or $20,000 of sales revenues, and so on. In this particular case, if we were to graphically represent this mixed cost that I've just described, where the rental rate is, well, it's $1,000 a month plus 10% of our sales revenues, we would create a line that looks something like this. At zero volume, we rent this place, but we have no sales. We are still going to be obligated to pay to the landlord, in this particular case, $1,000. That's the flat rate. So I can plot this point that at zero volume, I'm going to owe, in terms of total rental cost, $1,000. But if in fact we start to make sales out of our store, and in fact in a particular month we make $10,000 of sales, then 10% of that, according to the contract in this particular example, we'd owe an additional $1,000. Or the total rental cost would be the base amount of $1,000, fixed amount, plus an additional $1,000 kicker, or $2,000. If in fact we increase our volume to $20,000, then the additional rental cost would be 10% of $20,000, or $2,000 added to the base amount of $1,000 would be $3,000. So this line here represents the total rental cost under this contract with the mall. And some of it is fixed and some of it is variable. We can distinguish the fixed portion of this mixed cost as the point of intersection with the vertical axis. At a zero volume, we still have a cost. That is the fixed portion of this cost. It's $1,000 a month, regardless of how much we sell. But a portion of this rental cost is variable. That portion is predicated on the slope of this line. And we can determine the slope by taking any 2 points on this line and looking at the rise over the run between those 2 points. And if I do that in this particular case, if we look at the 2 points where it intersects the vertical axis, and this point at $10,000 of volume, the rise would be $1,000. It increased from $1,000 of cost to $2,000 of cost. So the rise would be $1,000, and the run would be zero volume to $10,000 worth of sales revenues, or a $10,000 increase. $1,000 of increase over $10,000 change in volume represents a 10% increase, which is what we reasonably anticipated when we knew the contract had spelled out that we're going to have to pay 10 cents on every dollar of sales revenues, or 10%. So we can break out the fixed portion of this mixed cost, $1,000 a month, and then accumulate that with the other fixed costs as we designate and try and identify all of our costs and distinguish them as fixed or variable. We can take this rental cost and say, put into the category of fixed costs, $1,000 of fixed cost associated with our rent in the mall, and a portion of it is variable cost determined on a variable cost per, in this case, sales dollars basis, and that variable cost per sales dollar represents 10 cents per dollar of sales, and it is a variable cost. Well, the fact of the matter is there are some mixed costs that aren't so clearly distinguished in terms of that portion that is fixed and that portion that is variable. For example, in many businesses, utility costs are kind of a mixed cost. There's some portion of the bill that you get that represents a fixed cost, and there's some portion that actually is variable depending upon the volume of business, manufacturing, production, or sales that you do. So even though in a utility bill we might find that there is some portion that's basically fixed regardless of what volume of business we do, that a portion of that utility bill is going to be variable and depends upon how many units of production and sales that we have in any period of time. In this particular case, where you truly have a mixed cost like this utility bill or utility cost, and if in fact you want to do CVP analysis, which is what we're going to want to do here as we move on in this lesson, what we're going to have to do is we're going to have to somehow distinguish what portion of these utility bills are fixed and what portion are variable, and separate them out so that we can capture all of the fixed costs together and all of the variable costs together. So how would we go about doing it when it isn't spelled out in some contract like it was, when we were renting space in the mall? What we can do is we can use a couple of methods here. One method is called the scatter graph or visual fit method. Another method is referred to as the high-low method. And in fact, there's a third method called the least squares method. We're going to just focus on some very fundamental and easily implemented methods, the scatter graph visual fit method or the high-low method.